Good morning. I'm Paul Denning here at SuperReturn Asia 2014 in Hong Kong. I'm pleased to be with Robert Petty. Robert is the co-founder of Clearwater Capital Partners, one of the largest and most experienced credit opportunity investors here in Asia. We're here today because at the conference we've heard about the credit cycles and how much credit is available and maybe some of the hazards ahead of us. So, Robert, could you tell us a little bit, please, about Clearwater and maybe some of the opportunities you see going forward?
Thank you, Paul, and really a pleasure to be here at Super Returns and together with you. So, as you may know, Clearwater is dedicated to Asian credit and Asian fixed income only. We have been doing that for almost 15 years now, and we have 80 people across our 5 different offices in Asia and also in New York. So, in-country focus, and also not just think about geographies, but we like to think about the opportunity set. Geographical is the typical way to break it down, but we like to think about industry and industry sectors. And so when you ask about opportunities and rightly point out the fact that credit has grown dramatically statistically, particularly in China, but the market has grown from a $9 trillion market when we started this business 14 years ago to $30 trillion today. And most notably, that spike has grown by $10 trillion just in the past 5 years. So the opportunity set has grown, but with it has also come the nervousness, appropriately so, about excessive leverage in the system. From our perspective, we think of that as an opportunity set, but there's absolutely good reason for caution. Specifically, we are concerned today, right now in September of 14, around the absolute rate in the US dollar pan-Asian markets. Rates, if you use US high yield at 6% and Asian high yield at 9%, Asia high yield is relatively attractive, but it is still, absolute rates are, on a dollar-denominated basis, we think too high. Onshore, interestingly, in China, in India, and some of the local markets, actually the private markets are still delivering 15% senior secured deals. And that's where, as we think forward, we think the opportunities are going to come about.
Interesting. Well, we see in the U.S. markets too, the distressed investing, credit investing is becoming more and more popular. But the good news for you is there are fewer and fewer skilled people to do this, particularly with experience levels like yours. Here in Asia, I think a lot of folks have been looking at China with the Alibaba IPO here recently, got a lot of fanfare. But we also, if you look behind the scenes, see that the debt is increasing in China. India is peaking up. Where do you see the opportunities there?
So specifically, the largest opportunity sets are these in-country local markets, China and India, as you rightly point out. Interestingly, they're at different debt levels and different stages of their economic cycles as we think about it. So a different answer for each of those geographies, but interestingly similar phenomenon. State-owned banking systems where they have control of credit and thoughtful about that. So China has reflated and clearly put in a lot of capital. They are now consciously, I would say, 2 years into beginning to manage that transition from a manufacturing economy to a service economy. They're doing that successfully, but it is with real pain, specifically around manufacturing and the like, and specifically around local government vehicles and in parts around the property space. So those areas of credit are coming under pressure. That actually creates opportunities. If you can do senior secured deals and participate in the evolution of the financial services industry to lending to the services space and that non-bank lending space, as you saw take place in US and Europe, we're believers in that. But we think it's a 2 to 4 year cycle, and being very thoughtful about your underwriting, we see that bubble and absolute debt leverage coming down, but it will be a difficult transition and a cautionary time to be investing in credit. We think an interesting time because you can get good rates and there are fewer players, to your player's point, but part of the economy where it's still just ending the boom time. India's done quite differently. There actually, we have to give them great credit at the Reserve Bank for having really brought down the absolute rates of credit and most importantly the rates of inflation. So not only is it Modi and the central bank together, we think that the economy is in quite good shape to really have actually a reflation through lending and the like. And so maybe a little further along that classic cycle of credit in India than it is in China. But both are interesting markets if you stay at the senior secured part of the level, and the scale of these markets is worth just reminding people how large they've gotten, particularly since the global financial crisis.
Well, I wonder if you could too, if you could just take us down a notch. into these different economies, where do you see a firm like Clearwater has to have some operational experience, get in there and dig it out? It's one thing to lend the money, it's quite another to make sure you get it back.
You're dead right. People often ask us, 80 people, what do you all do? And frankly, we have 55 at the Clearwater level, and then in-country teams are large platforms. And it's precisely to that operational component that is much talked about, but actually the execution of building systems, building risk management teams, and building asset management teams, so that not only are you putting dollars out, but you actually have systems to track those, to roll up portfolios, to think about management of your treasury, and to think about risk management both at the individual company level, where we have asset management individuals, members of the team who worry about not, oh, they didn't pay me today, but thinking about it 6 months, 3 months ahead of time, and working with your borrowers. When you're doing private direct lending, you need to work with your borrowers and know your companies intimately. So it takes resources, and it takes resources both at sort of the best of class underwriting standards on a global level, as well as an asset management level, in each of these economies with each of these companies you've lent to. So that's how we've approached it, and I know that you're dead right to worry about, it's one thing to put out the dollars, can you get the dollars back?
And maybe one last question, and I don't know the answer to this. As far as fund size, as far as the capacity for investing prudently, how does Clearwater go about that?
We've always thought about 4 different opportunity sets within Asia. So we've done a core fund that is a 4-year investment period, so we've had the duration, and we think it's important to be able to have capital countercyclically, because there are great countercyclical opportunities across Asia. And so we think about that, and we are able to go into Korea when the mutual savings banks are going bankrupt and nobody's lending there, or go into India on a countercyclical basis when other people aren't there. And we think that's important. But we actually right-size those funds, and so under $1 billion every Clearwater fund, and consciously this most recent fund, we co-invested 3 different deals, and we think co-investing is particular transactions.
Yeah.
So right-sizing your fund under $1 billion, give yourself Pan-Asia, and then particular opportunity sets, whether it's direct lending, as we think today onshore, or whether it's secondary credit or a particular sidecar, is where we've grown capital opportunistically along with our LPs.
Great. Well, sounds like your checklist is in good shape. Anyway, thank you very much, Robert.
Paul, thanks for
It's been a
taking the
pleasure.
time.
Yes, sir.
Pleasure.
Yep.